Hey everybody, and welcome to today's episode of Deconstructing the Home Show. Today we're gonna talk about something that is a really good question to have to be asking because it means you're making money. And I want to talk about a concept that not only definitely applies in real estate, but applies in business in general, and that is the opportunity cost of money. So what does that mean? Opportunity cost of money basically means that if your money is being used one place, it can't be used somewhere else, right? If you buy an iPhone, you can't go buy another iPhone because the opportunity has already been used by your money to buy one iPhone. That is true, again, all over business, but definitely in real estate. It's something that needs to be thought through because it will affect your investment philosophy and strategy. So the opportunity cost of money also goes into whether you are going to be mostly an active or a passive investor. So an active investor, pretty obviously, is actively investing their money. They are not giving it to someone else. They are not loaning it to someone else. They're not necessarily focusing on partnering on deals. They are doing their own active investing. They're using their money. You are putting time as well as money into what you're investing in. Passive investors obviously have a much lower time commitment, and they are primarily partnering or loaning their money out on other people's active projects. And if you're active, most likely you will be hopefully making a little bit more. You may have a little bit higher risk level in there, but you can make more. That's the category that I currently fall in at this point in my life in business. Passive investors are usually sometimes retired people. They're older. Maybe they have a second career that they love, and they want to put some of their money, diversify their investment portfolio, and use that money to invest in real estate. But back to opportunity cost. So if your money is tied up somewhere else, you can't do anything else with it. And that's primarily important if you are an active investor like I am. And if you're an active investor, you can take your money and use it, and probably in a shorter amount of time make more with it because you're actively involved, you're spending the time, you're finding the best deals, you're finding the absolute best contractors, you're being very active in the management of everything. And so if you allow your money to sit in an investment for a long period of time, you are not being able to actively use it. Now, you may be active on the project, but your money has now to some extent become passive. And that's a very important distinction that I actually very recently realized as I liquidated some of my smaller rental properties. I had several pieces of property that I've recently sold over the last few months that were small, multifamily, duplex, triplex, fourplex, those sorts of things. And I sold them because I realized that not because they were bad investments, not because they weren't necessarily making me money, not because they were even not appreciating in value, they were actually doing all those things, but I realized that I could do better if I sold that. I pulled what I'd already made out of the deal out and reallocated those funds to other projects that I could be more active in or that were shorter term plays. So whether it's a long versus short term plays, a long term play is obviously something you are going to potentially own for years and years and years, and it hopefully will appreciate in value, and hopefully it will have cash flow that allows you to live and leave the job that you hate, or just pay your bills or pay your team or whatever it happens to be. And so that's a long-term play, and hopefully you'll be getting a good rate of return all the way along. But again, if you have capital allocated and tied up in that deal, it can't be used to do anything else. So for me currently, I'm able to make more money by actively rehabbing and selling homes or building new homes than I can by leaving my money tied up into a rental property. So I had sold a piece of property that had seen some really great appreciation. They had cash flowed while I owned the properties, but now I had some other opportunities that were presented to me and in front of me. And my, let's just say $100,000 of profit in a project was tied up there. And maybe that 100 over the next 3 years would become 200. Oh my gosh, incredible rate of return, which it is. But if you are active and you are really looking and finding great real estate deals, maybe you could take that 100 and double it every year. So 100 to 200 in year 1, 200 to 400 in year 2, 400 to 800 in year 3. That is possible in real estate. That's pretty much where my deals currently are. I am pretty much doubling the allocated capital within a yearly time frame, 100% return on my investment. So you have to be willing to decide whether you want to become more active or whether you want to let something sit. So you have to decide where in your life are you? Where in your investment phase are you? What is your risk tolerance level. If you have something that you know is appreciating, that's doing good cash flow, there's gonna be less risk there than selling that thing that you know is making money and reallocating that somewhere else. So there's definitely several things that need to be decided and definitely need to be thought through when making this decision, but it is important because if I hadn't made that decision and sat down and really said, where's my portfolio investments right now? How could this be best structured for maximum return for me? I would have probably let those properties sit and continue to appreciate. Again, this is a discussion that you have only when you've made lots of good decisions and your portfolio and your investments are heading in a good direction. But it does dramatically affect where you will end up at the end of the day and what your time commitment is currently. So remember the opportunity cost of money. Remember also that if you're making a 10% return on your money, but it's only being used 50% of the time, your annualized actual percentage rate is only 5%. It cuts in half and it would go down even more. So if you're only using it a quarter of the time, you're making 20%. You're only making, again, 5% on your money over an annualized basis. So those are the sorts of things that you need to be calculating and looking at when you're trying to make a decision whether this is a long-term good play that you want, whether you want to have long-term plays, whether you want to have mostly short-term plays. So the vast majority of my investment plays right now are shorter term, under 6 to 24 months. I'm not really looking to buy and hold lots of property. I'm looking to do massive value adds to the properties that I'm purchasing and rehabbing and then selling quickly. I'm looking to construct new homes. Again, a much shorter time frame. There's some pre-development stuff, but actually get the sticks on the ground. Hopefully you pre-sell some of that product. So it's a short-term play. I have currently one long-term play that was an old building that I purchased here in downtown. And I bought it about a little over 2 years ago now. And it was in an area that was just starting to come around, but it's a very unique building in a very unique area. And again, I've already made money on it. If I sold it today, I would probably make a very good return. But because the uniqueness of the property, because the potential cash flow that it will give me once it's being fully utilized and rented out the way I'm hoping it will be, it makes sense. So really, I have one long-term play, and all the other real estate deals I do currently are short-term plays. And that's just what's worked for me at this point in my time in my business. But I'm just challenging you to ask the question, think about whether your real estate investments are long or short-term. Think about the opportunity cost of money. If it's tied up somewhere else, it can't be used anywhere else. If you see a great deal, sorry, you can't move on that great deal that could double your money in a month because it's tied up. It's there, you can't use it. So consider the type of plays that you're making, consider the opportunity cost of money, and really use that to help you formulate an investment strategy that will allow you to go where you want to go in the end.